Hey everyone, welcome to another video on the channel. Today we're going to be taking another look at Zim Stock, Zim Integrated Shipping Services Limited. So I'm sure as everyone knows, Zim has just been crushed over the past week after that earnings miss. We're going to get into all of that and analyze what happened, what the future looks like for Zim. But first, we could see just looking at this chart, Zim had been range bound. For the past weeks, we had been kind of around the high $16 into $17 range until earnings. And then we did have that big 15% drop on Monday. And we're kind of staying down there. We've recovered from the as low as we had been, or from the lowest point that we were at, but we're still down. We're still trending downward. And it's obvious why, because of the earnings miss. And then on top of that, the announcement that they're not going to pay a dividend this quarter. But let's kind of dive in and just see what we're dealing with here and see how bad it is or see if it might recover. So obviously that was the big headline, that Zim crashes after quarter one results disappoint. We got that. So, they did. So they reported a loss of 50 cents per share in the first quarter. Now, last year, they had reported a earnings of $14.19 per share. So obviously it's a big jump, but we know that there have been these issues in the whole freight market. Analysts were expecting 27 cents per share loss, and it came in at 50 cents. So, a pretty substantial drop from what analysts were anticipating, even though they were anticipating a drop. The company's revenues fell 63% year over year to $1.37 billion, again falling short of analysts' expectations of $1.59 billion. So that's $200 million that they dropped by, more so than what analysts were anticipating. Pretty significant drop. And the company again announced that they won't pay a dividend, which I think again is why a lot of people were dumping their stock this week, because as we know, Zim is famous for those heavy dividends. If you had just bought Zim in 2020 and been holding on to it, even though the stock price dropped from the 70s or even $80, whatever it was at its height, you still would have made a few bucks, but because of those dividends. But now without those dividends, can they hold on to their shareholder base? Well, some people clearly have got cold feet and have dropped the stock. Now, more importantly though, what is the company's outlook? So they expect adjusted EBITDA between 1.8 and 2.2 billion, and adjusted EBIT between 100 to 500 million. And this is a key part. In light of its expectations for improvement in market conditions during the second half of 2023. Now, we're going to get into that in a second, because that was something, if you listen to the earnings call, they did reaffirm their 2023 guidance, which, was a positive sign, especially given the fact that they did miss this quarter. The fact that they're counting on that they're still going to hit their annualized numbers, shows that the company has confidence. But is there a reason for that confidence? Let's see. So if we look over here at Yahoo Finance, they go even deeper into the numbers. Again, 63% sales decline. That's tough. Carried volume was 769,000 TEUs, a decrease of 10%. Okay. Not the best. And company an EPS loss of 50 cents, down from $14.19, as we just said. And operating cash flow, 174 million. 174 million in Q1 last year, this year, compared to 1.7 billion a year ago. So prices, the numbers aren't looking great. There's no way around it. But keep this in mind. I thought this was something worth pointing out. This article talks about how, like, yeah, the numbers are pretty bad, but it's kind of in line what we were already expecting, especially considering this is our favorite chart we had brought up in the past, the Freightos Baltic Index. So you could see, as we already knew, so we peaked in 2021 when we had all the supply chain disruptions and the post-COVID or during COVID chaos and whatnot. And things were going pretty well until the second half of 2022. We started seeing this decline that we saw all throughout the rest of 2022. And now here we are in 2023. And what's happened? I mean, we're still, we have not been able to rebound, but we've basically steadied out the decline. And keeping in mind, that was so much of Zim's problem, is that they have so much exposure to the spot market as opposed to those longer range contracts. So the spot rates were hit, their profits are going to be hit. But now we'll see if rates are able to stabilize. As we've seen, the rates have been declining at a much slower clip. And so there is reason to think that's what they said in their earnings call, and we'll see what happens. And that's kind of what this article is saying, is we'll see if things are able to improve in the second half of 2023. Everyone was expecting the first half of 2023 to be tough as the rates stabilize, but we'll see if in the second half rates will, begin to rebound a bit. I mean, they won't go up to 2021 levels over here, but we'll see if they improve. And if they do improve, that's going to bode a lot better for Zim and the whole industry in general. So, from management's perspective, they do have some pros and cons. This was a bit of a shocker almost. From a geographic standpoint, the largest decline was in their intra-Asian segment, where they reported revenues of 161 million, where in the first quarter of 2022 it was 600 million. That is a serious decline indeed in their intra-Asia market, although we've said too that they are trying to diversify their product lines and their businesses, but also in the Pacific revenue. So in the Pacific segment, they had $1.7 billion in revenue in Q1 of 2022. Now it's down to 428 million. So we'll see what happens. A lot of that had to do with, in the past, we had discussed the China reopening play and how that might impact the rates and what was going on in China, or the COVID situation, if that had gone down, how that might impact the freight rates, and also just if they could, a lot of their business is going from China to the west coast of the U.S., and so we've seen that those numbers are declining, and we'll see if they could rebound, or if they could find other trade routes to go to. We had said in our earlier videos they had been trying to increase their trade outside of this China to the U.S. West Coast kind of corridor, which is clearly declining. But can they make it up by trading in other places? We'll see. We'll see. But, and it says, right, so since April, the Pacific segment, which we just said, where it went from 1.7 billion in Q1 of 2022 to only 428 million in Q1 of 2023, has rebounded of more than 50% compared to its March lows. You can see that over here. The East Asia to US freight rates. So, and we'll see if that is impacted in their next earnings. But I just wanted to bring this up. This is some other things that this article talks about is, and we've already discussed this, but, they're, on the positive side, they have been transitioning to more LNG vessels. which will help them in their ESG rating and make them more, um, you know, make other hedge funds or people, the big money would look more favorably upon this. Also, we knew that, they're going to pay their profits in dividends to their shareholders. They've made that super clear for a long time at this point. And what's good about them is that they have right now $4.25 billion still in cash. Now, they could have said, okay, we have all these billions of dollars in cash. Let's pay that out as dividends to our shareholders so that we avoid kind of a situation we saw this week where a lot of the shareholders kind of get cold hands, cold feet, and dump the shares. So they didn't do that, which, it really does show that the management team there, they're not going to change their policy based on short-term considerations. They're going to hold on to that cash to get them through this tough time that we're in right now. So it just shows that they have discipline. Their management team is disciplined. They're not just going to throw their money around for temporary stock movements up or down, and they're going to use that cash to get them through the harder times. And as we know, there are more ships coming online, both with Zim and in the industry in 2023 into 2024. There is going to be more of a glut in the market. I think that's going to cause some of these shipping companies to go out of business or to have serious downsides. And I think once that happens, that's going to be better for Zim. That's going to kind of reverse the process and create a situation where, okay, these other players have gone out of business. Now there's even less competition for them. So we'll see if that comes into effect over the coming quarters. And also, this is interesting that, a lot of their shares are owned by this Israeli fund, Kenan Holdings, which the state of Israel, they're an Israeli company, of course, prevents them from just dumping shares. I've heard people say with a stock like Apple, for instance. So obviously Warren Buffett owns a ton of Apple. So, people feel more comfortable investing in that sort of a company because they think, well, if the stock ever gets too low, a guy like Buffett or some other deep pocket interests, they're just going to pour money onto it because they don't want the share price to go too low and hurt their own bottom line. And so, it's the same thing here in terms of there are these institutional holders like Kenan Holdings that already own a ton of shares for the long haul. They don't want the shares to go down as much as it has been. So they have a further incentive to also pile on when the price gets low. But we'll see. Again, this was a hard quarter. We knew it was going to be tough into 2023, given the fact that there are these all these headwinds coming at the shipping industry in general, particularly the spot market. But we'll see if they can recover. I'm going to be really curious in the upcoming earnings to see if Zim, their own management, is correct that the second half of the year we do see some sort of a rebound, or if we do see further stress in the shipping industry, which might cause their competitors more problems than it causes Zim. There are competitors that don't have billions of dollars of cash sitting around, and so therefore might go bankrupt or might have these other problems that might ultimately help Zim as well. So let me know what you think in the comments section. Are you holding on to Zim? Are you selling Zim? Are you buying more shares of Zim? And don't forget to like and subscribe, and I'll catch you in the next one.